Have you been looking for opportunities to expand your dividend portfolio, but feel lost among so many companies? Do you find it impossible to keep up with the fast-paced world of investing, or are you a complete beginner? Then stay with me until the end of this video, because today I've brought you a very interesting company. Hi everyone, in today's video, we will take a look at the company called Realty Income together. Realty Income got its start in 1969 with a single investment in a Taco Bell. Today, the retail REIT owns thousands of properties across America, leased to hundreds of tenants operating in dozens of industries. Retail properties account for most of the firm's rental revenue, with industrial warehouses and gaming venues generating almost all of the remainder. All properties are under long-term triple net lease agreements, which shift property operating expenses to tenants and generate predictable cash flow to fund monthly dividend payments. The company currently pays an annual dividend of $3.07, distributed on a monthly basis. The next payment will be on February 14th, and anyone who becomes a shareholder by February 3rd will be eligible to receive it. At the current stock price, the starting dividend yield is 5.89% compared to the 5-year average of 4.72%. The forward price per AFO ratio is 12.5, whereas the 5-year average was 16.5, and the sector average is currently 16.2. Over the past 12 months, the company has significantly underperformed compared to the S&P 500. Based on this, it appears to be undervalued at the moment. The most recent dividend increase was 3%, which is below my minimum expectation of 4%. However, from a company offering such a high starting dividend, significant growth is not to be expected. The 5-year average increase was also 3%, while the 20-year average was 5%. The AFO payout ratio has been on a declining trend and stood at 75% over the past 12 months, which seems very healthy. AFO per share has been steadily increasing year over year, and at a faster rate than the dividend. As a result, dividend increases may accelerate again in the future, or if the company faces a few weaker years, the dividend will still remain secure. The shares outstanding chart shows a strong upward trend, which is entirely normal for a company like Realty Income. This is one of the ways they finance their growth. REITs receive tax benefits but are required to distribute a large percentage of their profits as dividends to shareholders. This limits their ability to grow quickly through retained earnings, so they rely on issuing shares and taking on debt. Debt levels are also at a completely healthy level, and a declining trend is visible here as well, which is reassuring. The company is currently available with a starting dividend yield of 5.89%, which has been increased by 3% in recent years. Its credit rating is A-, which is considered good, meaning the dividend is not at risk. Additionally, the stock appears to be undervalued. Key financial points: investments and returns. During the quarter, $740 million was invested, including $378 million in the US, with an initial yield of 7.4%, and $362 million in Europe, with an initial yield of 7.3%. AFO, growth and profitability. AFO per share was 1.55, representing a 2.9% growth compared to the previous year. Portfolio performance and stability. The real estate portfolio occupancy rate stood at 98.7% at the end of the quarter. Rent recapture across 170 renewed leases was 105%. Financial flexibility and capital position. The company had $5.2 billion in available liquidity at the end of the quarter. Debt levels remain manageable through 2025. Overall evaluation. The report is mostly positive because it shows stable revenue and AFO growth. High portfolio occupancy and positive rent recapture rates were reported. The company maintains significant liquidity and a manageable debt level. Future guidance indicates further growth. Although economic uncertainties remain, the company's financial position and strategic direction suggest strong and sustainable growth prospects. Project 2025 is an initiative spearheaded by the Heritage Foundation, a conservative think tank, aiming to reshape the U.S. federal government under a potential future Republican administration. The project outlines comprehensive plans to centralize executive power, reduce regulatory oversight, and implement conservative policies across various sectors. Potential impacts on the company, short-term effects, regulatory changes. The project proposes dismantling or significantly reducing the authority of federal agencies such as the Environmental Protection Agency and the Federal Trade Commission. This could lead to immediate changes in compliance requirements, potentially reducing operational constraints for companies in industries like energy, manufacturing, and technology. Tax reforms. Project 2025 advocates for overhauling the tax system, including reducing corporate tax rates and shifting towards a consumption-based tax model. In the short term, this could result in decreased tax liabilities and increased after-tax profits for corporations. Long-term effects. Market dynamics. The proposed deregulation and reduction of federal oversight might foster a more business-friendly environment, potentially spurring innovation and competition. However, the lack of regulatory safeguards could lead to market volatility and increased risks, particularly in sectors like finance and technology. Social and environmental considerations. The project's stance on environmental deregulation and social policies may lead to public backlash or shifts in consumer preferences. Companies may face pressure from stakeholders to uphold higher environmental and social governance (ESG) standards, potentially leading to reputational risks if they are perceived as aligning with regressive policies. In summary, while Project 2025 aims to create a more streamlined and business-friendly regulatory environment, companies must carefully assess both the opportunities and risks associated with these proposed changes. Strategic planning and stakeholder engagement will be crucial to navigate the evolving landscape effectively. Disclaimer: this video does not constitute investment advice. Do not make decisions based solely on the content of this video. Always do your own research to determine whether a company aligns with your investment strategy and portfolio. Thank you for joining us today on the Financial Freedom Channel. If you enjoyed the video, don't forget to like it and subscribe so you can stay up to date with the latest financial tips and analyses. If you have any questions or would like to share something, feel free to leave a comment. Remember, we're building financial freedom together. Stay with us and we'll see you in the next video.